Why are so many real estate investors moving away from bank financing and over to private credit or hard money? Rates are so much lower with the bank. I mean, why would any active real estate investor purposefully choose to go with hard money versus paying a lower rate with a bank? That's because the answer isn't interest rate. It's not always about rate, it's about execution. If you have a good deal and you know it, your goal, first and foremost, above all else, is to close. And with a hard money lender backing you, the odds are that you're not only going to close, but you're going to also close within 2 weeks, and sellers know that. Banks are going to look at you and your entire financial condition relative to all the projects that you're dealing with. Maybe it be your personal residence, your W-2 income, what you own, the income it generates, how much debt you have, whereas a hard money lender is going to focus on the project. We're going to have a common sense approach to your requirements for that particular loan. A minimum credit score as an example, versus tying your credit score to the rate. We just need a minimum. If you exceed the minimum, you're good. If you're doing a project that only requires a certain amount of capital in terms of down payment and closing costs, well then our requirement of you is going to be sized to that project and that project alone. We're not going to be looking at the totality of all the things that you're involved with. And I think that is the key theme to understand between going to a bank and going to a hard money lender. So let's talk a little bit about how a bank is going to underwrite your bridge loan, your construction loan. And it's probably best when you do approach a bank that you approach a bank a couple weeks prior to even finding a property that you're looking to invest in. If you're looking to close inside of 60 days, you better have that bank lined up because, the bank is going to want to know about your W-2 income. They're going to want to see your tax returns. They're going to want to pull your credit up front and study it to make sure they understand all of what you're involved in. They're going to want to also understand what other projects you might have going on. They're going to want to look at your debt to income ratios as it relates to, other income producing properties. And ultimately, they're going to try to put together this complete package, this complete view on you as a borrower. And they're going to dictate what you can borrow based on that complete view. Hard money is experience driven. So what I like to say is the more experience you have, the less risk we feel we have as a lender. So we reward that experience with lower rates and higher leverage, higher LTV. So we focus on experience, and we focus on experience over the last 3 years. We're not going to ask you for tax returns. We don't care about your debt to income ratios. We're not going to verify your employment. We don't even care if you're employed. We lend to mostly, entrepreneurial folks who are out investing in real estate as their primary source of income. So we're completely experience driven here, and we're going to verify your experience as a first-time borrower. We look at your credit. Sure, we'll pull your credit in a background check on you, but we only want to make sure that your credit is at least a certain number. Let's say for experienced investors in our fix and flip or ground up construction programs, you just need a credit score of 660. So you need to make sure that you have the ability to show that you have the down payment and closing costs in a bank so that we know that you at least have the amount you need to close. We also want to see that you have access to a little working capital to know that you can make loan payments if needed, or you can put deposits down for contractors or buy materials and get them to the site. One way or another, you'll have to have a little bit of liquidity beyond the down payment and closing costs in order to qualify. So the major 3 factors that a hard money lender like myself will look at will be your experience first and foremost. We want to make sure that you at least meet a certain credit score minimum and that you have the appropriate amount of liquidity for that transaction. We're not going to look at anything else. Your other projects that, are maybe at 90% LTV or underwater on a DSCR basis, no. We're going to look at that project. We're going to want to make sure that you qualify to do that project and that you have an appropriate amount of cash in the bank in order to execute. And it's that type of approach. It's a common sense approach to underwriting that I believe the hard money or private lending space provides that, makes it enjoyable for borrowers to come back over and over and over again versus going again to a bank. The most common when you're trying to compare why a borrower would go with a hard money loan or a bank loan is in our fix and flip program. Because any smart investor knows that you're going to make money when you buy the property right, period. The reality is in situations where you're getting a great price. Most likely there are several other competing offers, and that the seller is looking to dump the property and is looking for a fast execution and one that has the certainty to close, almost like cash. And that immediately eliminates the banks, because banks simply can't close inside of 20 or 30 days. At least I've never seen a bank close that fast. So inherently that means that you have to come to a hard money lender like myself that can get loans closed in less than 2 weeks. Because when you're a buyer buying opportunistically, looking to get a great price on a distressed asset, you need a lender like myself that acts like cash. So we know that hard money loans are really bridge loans. They're short-term loans that are able to close quickly because we're using private funds, right? So we have no red tape. We can get deals closed quickly. So we're perfect for fix and flips, builders who want to build ground up construction, single family homes, townhomes, investors looking to buy multifamily projects and renovate and add value through a lease up. Those are projects that typically can get done inside of 12 to 18 months that benefit from a fast moving close and fast moving construction draws until stabilized and either sold or refinanced out. Well, what do banks do well? And to me, banks are going to be better at the projects that require a little pre-development. You have to make sure that when you're going into a bank loan, it makes sense, or if going into a hard money loan, and that you're not going to be in a project for 18 to 36 months, that you're not taking a risk going into a hard money loan, that all things are going to go exactly perfect and that you're going to execute within a very tight time frame, versus giving yourself the relief of knowing that you have a lower interest rate in a 36-month term with the bank, and that you can come to us, the hard money source, for when it matters, which is to build and go vertical and to get those houses constructed and sold. Focus on time frame above all else and you'll be fine. Successful real estate investors never rely on a single source of capital. They'll never only borrow hard money or only borrow bank financing. They want to match the financing program with the opportunity. And that's so critical to understand, because not all projects fit a bank or vice versa fit hard money. My name is Mike Chadwick. I'm a loan officer with asset-based lending, and I would love to talk about any of the opportunities you're looking at in hopes of maybe providing financing for one of your future projects. You can reach me at Mike Chadwick on social. And as always, please don't hesitate to like or leave a comment if you have any questions. Thanks for watching, and I look forward to the next one.